Hi, I'm John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today, let's talk about the hidden trade-offs between high lifetime income, guaranteed lifetime income, and growth in an annuity contract. With annuities, you're getting one or the other. Well, you can get both. But if you want the best, growth, don't get an income product. Okay. If you want highest lifetime income, contractual pension income, then get an income product. It may have a little growth, but its strong suit is income. And I'm going to show you, I'm going to share my screen. I'm going to show you the difference between these two. Because a lot of times people reach out to me and they're like, John, I want an annuity. I want lifetime income, but I want lots of growth and I want to leave it to my family and it's going to be great. Right? I'm going to make all this money. And I'm like, yeah, well, no, it's not going to, you have to split it up. It's not a complete hybrid approach of both. You can get a hybrid approach, but a hybrid approach means that one or the other is going to suffer. Okay. And you have to be okay with that. And you have to realize what you're giving up for the other. What is the trade-off? Okay. So I wanted to share my screen and show this visually to you so you can kind of see how this works. And if you're looking to purchase an annuity, I sell annuities. Okay. I work with over 70 carriers, thousands and thousands of indexes and income riders and SPIAs and DIAs, you name it. I help people with whatever they're looking for an annuity contract. And if you watch my videos, you'll notice that I like to share everything, regardless of what my commissions are. Some of these pay me high commissions and some of them pay me hardly anything. But it's important for me to show you everything so at least you can make the best decision for yourself instead of being pitched something that you're hoping is best for you, but you're not really sure. Because a lot of times advisors will pitch you something and you're hoping that they're looking out for your best interests. But a lot of times it's not really the case. They're looking out for some of your interests, but mostly theirs. Okay. So it's important if you're looking around, research. And if you don't know where to research, go to my website, johnstevenson.com. Okay. Check out my annuity calculators. They have a direct feed to the carriers and you will see all of the options. If you're looking for highest income, go to the income rider. That's typically the highest. If you want to look at other income products, look at the SPIA or the DIA or the QLAC. Okay. If you're looking for just fixed rate of growth like a CD, then look at the MIGA options. Okay. They're all there. And that's why I just like to, here's what they are. If you want some help, of course, then you can book a call with me. There is a link below this video and there's a link on my website, johnstevenson.com. All right. So let's chat about this and let's just do this visually. I'm going to share my screen and let's go through this together. Okay. So the hidden trade-off, let's talk about this. So this is a fictional client in South Dakota. They've got $500,000. They just sold their farm and they're like, I want to buy an annuity that's going to replace the income I've been currently receiving, but I'm going to wait. I'm going to wait till I'm 65. Okay. I'm going to wait till 65. I'm going to let this thing grow because if I take it now, it's not going to be as much, right? So what is the highest payout I can get, John? So what we do is we plug in the $500,000 South Dakota and you know what? Let's just make him married. Okay. He's married. And the spouse is the same age, just to keep it simple, okay? So now the insurance company is on the hook for both of them, okay? It's a joint payout. They both get it for as long as either of them are still breathing. So if we look at this, here's the payout. Nationwide happens to be the highest payout, and it's $52,000 a year. Okay, it'd be a few $1,000s more if it was just the husband, okay? He sold the land, let's say she passed away or they divorced, and he's just looking for income for himself. Then he would just do it for himself, and it'd be like $55,000 instead of $52,000. So if we look at this illustration, this shows us how it works. So this happens to be the Nationwide Peak product. He's putting $500,000 in, and the benefit base is at $675,000 after the first 12 months. And I'll show you how that works. Eventually, at the end of it, it's going to be worth $875,000. So, and you notice that they're getting a growth rate that is guaranteed. And the lifetime withdrawal rate pops up by the time he reaches 65. So that's why this product works better, because it pops up at that age. So if we look at the numbers on what you're paying for, this is the income rider, then let's see, where is that? All right. Income-based bonus, 25%, and a simple roll-up rate of 8%. So the roll-up rate, they're taking $500,000 multiplied by 8%, and now you got $50,000. $50,000 is hitting that benefit base every single year without fail. But there's more, right? You got the income-based bonus also, okay? That's 25%. That's a big deal. That's why when you go up here and say, okay, What am I getting for these fees? See these fees? I'm paying fees, John. What am I getting? Well, you're getting this. This is the result of the 25% benefit base and the $50,000 roll-up rate. So you can see the 8% simple roll-up rate right there. Every year thereafter, it's the same 50 grand. Keeps popping on there, right? The end of 5 years is 875,000 guaranteed, and that's multiplied by 5.95, giving you 52 grand a year. Okay? It's that simple. Everything over here is just fluff. Okay. This interest rate, you may or may not get it. If you get it, good. Your account value is going to be 559 and your death benefit is going to be whatever this account value is. Or if you decide to cancel the policy, then it'll be this subject to a surrender charge. So if you wait 5 years, it'll probably be 5 or 6% on the surrender charges. In fact, I'll show you. Okay. So wait 5 years. So the end of 5 years on the 6th year, you surrender it. They're going to charge you 6% to take it out. But you're buying this for lifetime income. So it really doesn't matter if you're buying it for the right thing because you're never going to surrender it. So, but it is nice to know that it does have cash value. That's why you can look over here and you can see here's the surrender cash value, here's the death benefit, and obviously the death benefit you're never going to be penalized. Your beneficiaries won't be penalized. Okay, they're gonna get the whole thing. So, but really what you're doing is you're buying a pension. Okay, you're taking 500 grand, you're buying a pension that's worth a lot of money, like $1.5 million. Okay, so but there is a trade-off. What is the trade-off? Well, the trade-off is you're only getting 6%. Okay, when you do get it. And if there is a long recession, you're getting zero, nothing. That's the trade-off is your account balance doesn't last very long, but you get high income. Okay. Now let's compare. Let's just say I don't want to pay the rider fee. I don't want to have as high of income and I want higher growth. Okay. Well, Midland is the best one for that. Now it's not 52 grand a year. It's 30,000 a year. That's guaranteed, but there's a trade-off for less income. The fact is, and again, they show you here's 30,000. If there's no growth, again, the trade-off is look, you'll have less income, but your account balance lasts a whole lot longer. And this is the guaranteed section, but there's more. You could get more growth than the other one. And if you do, your account balance is not ever going to, it's not going to go completely down to zero. You'll have a death benefit. Okay. And you possibly could take out more income if we get this kind of growth rate. Okay. There is a trade-off. The trade-off is like 52 grand is guaranteed. Like if you buy the guaranteed one from Nationwide, that is guaranteed. And the index will earn whatever it earns and the account value will last for as long as it lasts. Right. But you're buying it for the guaranteed income. That's why you buy it. If you're willing to just have, the trade-off is you're okay with less guaranteed income. You're okay with the fact that if there is no growth over the next 5 years at all, you'll have $30,000 a year. Not likely, but at least you know what your floor is. If there is growth during these years, then you possibly could get $45,000 a year. But again, that's lower than 52. But the trade-off is you have more growth in here. You have more growth, you have no fees, and you're able to leave some money behind for charity or for your kids as legacy. And that's kind of a happy medium. But I'll just tell you right now, most people, when they see this, they're like, absolutely not. I want highest lifetime income. My kids will get my stock, they'll get my house, or these other annuities that are for growth, right? There are other annuities that are not for lifetime income that give you more than this. I'll give you like half of the index. So if you're doing S&P 500 and the index says 30%, you're getting 15%. Okay, it's a lot higher than this that we're looking at. And the trade-off is there is absolutely no guaranteed income. Okay, it's all about growth and market protection. And those are great. I have clients that are in them. They don't use them for income. I mean, they can take withdrawals from them if they want to, but there is no guaranteed income stream. That's guaranteed by an income rider that you're paying for. That's why you buy an income rider. You're buying a pension, and you're not, and that's what me and my wife are doing. Like, we're not doing this. We want the pension. I could care less about the account value. My kids can have my stock. Okay. So everyone's needs are different. Your needs might be different. I just wanted to kind of show you, here are the trade-offs. When you buy an annuity for income, buy it for income. Get the highest income you can possibly get for yourself. Okay. But if you want kind of a mix, then I would recommend taking a portion of your funds, buying an income product that's giving you the highest payout for yourself, and then maybe buying a growth product. Buy a fixed index annuity with a good company, good index, good renewal rate that has you getting half the index, right? Something like from Lincoln or Delaware. Like, those are good companies, good renewal rates. And you can get that. And you don't have an income rider attached. There's no fees. There's no guaranteed income, but it's a great place to park your money and get some growth, get some market protection. Okay. So it just depends what you're looking for. So I have people that do both. They're like, well, I want some money over here and I want some money over here. I want my income covered. I'd like to have some market protection, but I want some more growth, so I'll put this over here. That's the best way to do it. Otherwise, if you go right in the middle of the road, you get the worst of both. Okay, it's better to do one or the other or both, but separately. Okay. So that's really my message to you today is there are trade-offs and you have to decide which one you're willing to live with. Most people that contact me, they want highest lifetime income. They're looking to supplement their Social Security, their pension, or even maybe they don't have any of that and they need to create a pension because they've owned a business forever and they sold their business and they want to create a pension. That is a great way to do it. Annuities are great tools in your retirement tool belt to just say, all right, I want to take this much of my retirement money and I want to create a pension, the end. Okay. And then the rest of this money, I'll buy stocks, bonds, mutual funds, or whatever, and I'll let it grow. And if the market's down, then yeah, it'll be a bummer, but it's not affecting my lifestyle because I got my income covered. That is the thinking behind these, as you use it as a tool to help yourself have a comfortable retirement and at the same time be able to get the growth that you want over here, because it's nice to stay. It's nice to get that. It's nice not to be completely out. It's just hard to get out of that growth mode. And so this allows you to do both. So it's important to have some liquidity. It's important to have some growth. And a lot of times when you have that growth over here in this other account, this portfolio, you can, maybe every 5 to 10 years, strip some money off of that. Take 100, 200 grand, buy another income stream, another annuity, and just keep stacking them. It's just a nice way to stack your passive income, enjoy your retirement, and still get some growth, but just compartmentalizing them a little bit better. So anyways, hope that helps. If you want to buy an annuity, there is a link below this video. There's a link on my website, johnstevenson.com, and you can certainly book a Zoom meeting there and I'll answer your questions. And of course, I'd love to help you if that's what you're looking for. Otherwise, just check out my calculators. Go to my website, johnstevenson.com, and look and see and do your research, see what's out there. And of course, reach out if you have questions. So if you like the video, subscribe, share, comment below. I'd be happy to answer your questions. I do appreciate you watching. I hope you find some value in these videos. Watch the rest of my channel. I've got lots and lots of videos that answer lots of different questions in different ways. And so hopefully that will be helpful to you in your search for the correct annuity, for the right pension for your retirement. So thank you so much for watching, and we'll see you next time.